Insurance as a risk management technique, part 2. So we already covered half of this chapter, but it was so long that we've split it out into 2. So let's start off with what are the requirements of insurable risks. So not all risks are commercially insurable. The requirements of insurable risks are listed here. There's 6 of them. And so number 1, large number of similar exposure units, and we're going to talk about these in a moment. 2, accidental and unintentional loss. That's what you're looking for risk to be insurable. 3, determinable and measurable loss. 4, loss not subject to catastrophic hazard. 5, large losses. And 6, probability of loss must not be too high. Even when the absence of these requirements, or in the absence of these requirements, the insurance may still be offered, and typically through the government. And we're going to talk about that a little bit as we move on. And the other thing is that we should view these 6 points as just like guidelines, rather than a be-all and end-all of the requirements for insurable risks. So, number 1, large number of similar exposure units. Now, one of the most important requirements from the standpoint of the insurer is that the probable loss must be subject to advanced estimation, which basically means that the number of insured exposure units must be sufficiently large that the exposures themselves must be similar enough to allow the law of large numbers to operate. Basically, you have to have a really large sample, if you like, so any information you derive from it is reliable. If only a few exposures are insured, the insurer is subject to the same uncertainties as the insured. So it can't spread the risk. It's insuring one person. The insurer has the same risks as the actual person they're insuring. They need to have a lot of them. The field of life insurance is actually one in which this requirement is satisfied really well. Life insurers have gathered reliable statistics over many years, and not just reliable, but a large amount of reliable statistics or data over many years, and they actually developed mortality tables that they've been proved to be very accurate as estimates based on people dying. Further than that, life insurance is well accepted, and a lot of people buy life insurance. It is relatively easy for the insurer to obtain a large group of exposure units. A lot of people buy life insurance. Here, the law of large numbers works well, that for all practical purposes, the life insurer is able to eliminate its risk. There's less unknown. That's what it means. It doesn't eliminate the risk of people dying, but the unknown. The risk that we're talking about is the unknown, and it can reduce to the point where it virtually eliminates the unknown. On the other hand, insurers may not be able to predict losses. Other insurers may not be able to predict losses nearly so well in areas such as nuclear energy liability and physical loss to ocean-based drilling platforms, because these types of losses happen very infrequently. And they can be pretty catastrophic, but they don't really have a big base to work with. So in addition to having a sufficiently large number of insured people or exposures, the nature of the exposures must be enough alike, so they must be similar so that reliable statistics on loss can be formulated. So it's not enough just to have a large group. The items in your group have to be fairly similar. It would be improper, for example, to group commercial buildings with private residences for the purposes of fire insurance, because the hazards facing these classes of buildings are entirely different. The physical and social environment of all exposures in the group should be roughly similar, so people should be similar within the group, so that no unusual factors are present that would cause losses to one part of the group and not to another part of the group. So buildings located in a hurricane zone, say off the coast of Florida, should not be grouped with buildings 1,000 miles away from the coast. It should also be noted that sometimes insurers act as risk transferees when it is impossible to obtain a sufficiently large number of exposure units to allow the role of large numbers to operate. So these requirements aren't hard and fast, they're just general guidelines. Sometimes insurers will take on a risk even when they don't have specific data on that risk, and they'll get specialist underwriters to look into it, and they may look at similar risks and try and come up with a way of making it work for themselves and for the insured. So the second point there was accidental and unintentional loss. That was a requirement. So there must be some uncertainty surrounding the loss. Otherwise, there would be no risk. If the risk of uncertainty has already been eliminated, insurance serves no purpose. We're talking about from the perspective of the person going to buy the insurance. The main function of the insurance is to reduce risk. Thus, if a key employee is dying from an incurable disease that will cause death within a short period of time, there is little uncertainty or risk concerning the payment of the loss. So insurance is not feasible. Theoretically, actually, the insurer could issue a policy, but the amount they're going to charge for that policy is going to be so large to cover both the expected loss of the person dying and the insurer's cost of doing business. The cost of such a policy would probably be far too high for the prospective insured. What's going to happen is they're going to ask them for more than they're going to pay out, so it's not going to make any sense. In all policies, insurers normally exclude any losses caused intentionally by the insured, and if the insured knew that the insurer would pay for intentional losses, a moral hazard would be introduced, and that causing losses and premiums to rise. Adverse selection is the tendency of insureds who know that they have a greater than average chance of loss to try to purchase more than an average amount of insurance. And this could be difficult for an insurance company because you end up insuring a whole bunch of people that have got higher than average losses. So your losses overall are going to be a lot higher than average, and so it's going to screw up everything you've done. Your premiums that you've charged are not going to be enough because you're expecting a more average book of business, more average type of losses, but you're getting higher losses because you've had this adverse selection. So that's based on asymmetric information. So that's when an insured possesses knowledge about likely losses that is unavailable to the insurer. Its existence, asymmetric information, its existence is one cause of adverse selection. So adverse selection in the insurance industry involves an applicant gaining insurance at a cost that is below their true level of risk. So a smoker getting insurance as a non-smoker is an example of insurance adverse selection. In general, insurers try to control adverse selection by investigating potential insureds and then basically looking into them and doing their research on them and then providing coverage only to those who meet specified standards in line with company objectives. This process of selecting and classifying insureds from among the many applicants is called underwriting. So before I move on, let me say that to illustrate the unfortunate effects of adverse selection would cause if insurers did not practice underwriting, consider this example of crime insurance. So businesses operating in high crime areas are the ones most likely to want to buy crime insurance, even at a premium, so that even if it's more expensive than really they would really like to pay. But firms that are in low crime areas, they're not really wanting to buy this insurance so much. So if an insurer does not engage in some degree of underwriting, it may find itself selling primarily to very high-risk firms. Subsequently, loss payments will be more than expected, and premiums will then have to be increased because the company is not making so much money, so it's going to have to increase its premium to increase its income. As premiums increased, however, fewer businesses will be interested in buying the insurance, And the only ones who will still be interested are the ones that are going to be the higher risk ones. At this point, and the companies that are the lower risk, they're really not going to buy it at all. So when this happens, the insurance arrangement may be said to have entered a death spiral in which it will eventually fail due to the lack of several of the necessary requirements. But basically, all you're insuring is people that are nearly guaranteed to claim from you. And the people that aren't going to claim, they say the insurance is too high. And people that are prepared to pay more for insurance, they're either risk averse or they've got, so they just don't want any risk, or they know something that you don't. They're selecting against you. Let's move on. So determinable and measurable loss. The loss must be definite in time and amount. Even if it is clear that a loss has occurred, it may not be easy to measure it. So let's look at this example. What is the loss from pain and suffering of an auto accident victim? It's really difficult to determine, isn't it? It is a real problem to insurers. However, to be able even to recognize certain losses, let alone measure them. So it's some losses you don't even know that they've occurred, and when they do occur, some of them you can't even measure. So let's take an example of an insurer may agree to pay the insured a monthly income if the individual should become so totally disabled as to be unable to perform the duties of his or her occupation. The question arises, however, as to who will make that determination whether or not the insured meets this condition. Often it is necessary to take the insured's word for it. So it may be possible for a dishonest person to feign illness in order to recover under the policy. If this happens, the second requirement, if we remember what the second requirement was, accidental and unintentional loss, is not met because it's not accidental or unintentional. Now, even if it is clear that a loss has occurred, it may not be easy to measure it. So again, the example we mentioned earlier, what is the loss from pain and suffering of an auto accident victim? Often, only a jury can end up making that determination, and it's still going to be a subjective judgment that they're going to make. What is the loss of a cargo? The cost of loss of a cargo of a sunken ship is at the bottom of the ocean. It often takes a staff of adjusters many months or even years to decide, and even ends up in court as well. These cases end up in court. Thus, before the burden risk can be safely assumed or taken on, the insurer must set up procedures to determine whether loss has actually occurred, and if so, its size. So let's move on. Loss not subject to catastrophic hazard. Conditions should not be such that all or most of the objects in the insured group might suffer at loss at the same time and possibly from the same peril. For instance, large fires, floods, earthquakes, hurricanes, in particular major geographical areas. So you want to really spread your risk out. You don't want to be taking a massive hit in one area, one location if you're not diversified. Most insurers reduce this possibility by dispersion of insured objects. Insurers themselves may purchase insurance against the possibility of excessive losses. So this is actually called reinsurance, and that's the shifting of risk by a primary insurer, known as the ceding company, to another, known as the reinsurer. Most of the reinsurance business that takes place ends up in London, in Lloyd's of London. They reinsure pretty much everything that goes on ends up being reinsured at Lloyd's of London, which you may have heard of. So following the 9/11 terrorist attacks, many firms had difficulty obtaining insurance for trophy properties. So trophy properties, they're unique in some way, like the Twin Towers were unique in some way. They were unique. That's the only properties like them that they were around. Due to the recognition of insurers of the catastrophic loss potential associated with these buildings. And what typically happens is that the government then steps in and says, look, we're going to cover you. Insurance companies aren't prepared to cover you. We're going to step in and cover you. How about large losses? Although an insurer theoretically might be willing to provide insurance regardless of the potential size of a particular loss, a requirement from the standpoint of the insured is that the maximum possible loss must be relatively large. The large loss principle states that business and individuals should insure potentially serious losses before relatively minor losses. To do otherwise is uneconomical because small losses tend to occur frequently and are very costly to recover through insurance. Proportionately, they're more costly to recover. If one can pay for a loss from savings or current income, it's probably too small a loss to give insurance high priority as a method of risk treatment. So as an example, suppose there's a 2% probability that a collision will completely destroy a $20,000 car owned by some corporation. The corporation may realize that the expected value of such a loss is 2% of $20,000, which is $400. So another way of looking, how can we get that $400? If there was 100 such organizations that own this $20,000 car, we expect 2 of those organizations, 2 of the 100, to suffer a $20,000 loss. So $20,000 for one, $20,000 for the other, and the other 98 not to suffer a loss. So your total losses will be $40,000 divided by 100 companies. That's going to be an average of $400 per company, and that's what the expected value is. So collision insurance might actually cost $750. So even though the company knows the expected loss is $400, the expected loss, the average loss, is very different to the actual loss. The actual loss is going to be $0 or $20,000 for that individual company. It's only that because the insurance company can pool its risk that the expected or average loss is $400, and that actually applies to the insurance company, but it doesn't apply to an individual. So, as I say, an individual, their loss is either 0 or 20,000. So even if the insurance company wants $750, they may still be willing to pay it. Okay, so the insurance company, why are they going to charge them more? Because the insurance must charge enough to pay for not just the losses, but also the cost of doing business. Now, should the company buy the insurance? What do you think? If a $20,000 car represents a large portion of the company's total assets, then insurance may be purchased. But if the car is one of a large fleet and represents only a small fraction of total assets, the purchase of insurance is going to be less likely. 6. The probability of loss must not be too high. The final requirement of an insurable risk is that the probability of loss must be reasonable, or else the cost of risk transfer will be excessive. This requirement is of concern primarily for the potential insured rather than the insurer. Due to the element of risk, insureds are often willing to pay more to avoid a loss than the true expected value of that loss, as we saw in the previous example. If it were not for this phenomenon, however, insurance could not exist, because insurance actually costs you more than your expected loss. So insurance must always charge more for their service than the expected value of a loss. So basically, it's people that are worried about their losses, that they're prepared to actually pay more than the expected loss. But again, remember, expected loss, from the previous example with the car, the companies either have no loss or a $20,000 loss. It's not going to have the expected loss. The more probable the loss, the greater the premium will be. And the point ultimately is reached when the loss becomes so likely that when the insurance expenses are added on, the cost of the premium approaches or even exceeds the full value of the item insured. So at this point, insurance is no longer feasible because the insured will not be willing to pay the necessary premium. As we move on In this video, I'm going to give you another example of this. So let's look at some examples of requirements of insurable risks. Do these risks meet the requirements of insurability? Now remember, these rules, these requirements are not hard and fast, so they're just guidelines. So let's look at the risk of a flood. And even the responses here on this graph are open to question. But let's see. Risk of a flood. Large number of similar objects. Is that right? Does that fulfill that requirement? Well, probably. It's probably depends where the flood is, depends how many people it affects, but possibly that's going to be true. Accidental and unintentional. Well, floods typically are determinable and measurable. Well, that's when it comes to the losses, you should be able to determine and measure them relatively easy. It's going to be mainly property damage. Not subject to catastrophic hazard. Well, that's not true. A risk, the flood will be a catastrophic hazard. Large losses, yes, potentially large losses to individuals being wiped out. The probability of a loss is not too high. Well, it depends where you are, where you live, but that's possibly the case. And you don't even have to agree with these responses, but these are just put there, and not just to show you the these six requirements of insurability, but also to show you how people think about them. And you don't necessarily have to agree with the way other people think about these, and you may have given different responses to the ones you see in this table. So it's moving on. Requirements of all valid contracts. So in general, there are 4 requirements that are common to all valid contracts. The first one, the agreement must be legal. Okay, so it must be legal in every way you can imagine. For example, I can't really make a contract that I'm going to start smuggling drugs and try to enforce that contract, illegal drugs I'm talking about. 2, parties must have a legal capacity to contract. So parties who have no legal capacity to contract include insane people who cannot understand the nature of the agreement, intoxicated people, corporations acting outside the scope of their charters and their bylaws or articles of incorporations, and minors. Minors are not allowed to enter that sort of contract. There must be a valid offer and acceptance. So the general rule in insurance is that it is the applicant for insurance, not the agent, who makes the offer. In property and liability insurance, it is the custom to give local agents, and we'll talk about agents in a moment, authority to accept offers of many lines of insurance on the spot. The agent will bind the insurer. So the agent's given the authority to accept offers from prospective insurers without consulting the insurer. A legal offer by an applicant for life insurance must be supported by the first premium. Usually the agent gives the insured a conditional receipt and provides that acceptance takes place when the insurability of the applicant has been determined. Promises must be supported by the exchange of consideration. So this is the idea about quid quo pro, something for something. So the insured's consideration, the person getting the insurance, is made up of a monetary amount. You pay your premiums, and plus you also agree to abide by the conditions of the insurance contract. The insurer's consideration is its promise of indemnity upon the occurrence of a loss due to certain perils, to defend the insured in legal actions or to perform other activities such as inspection or collection services, as the contract may specify. So typically you take out insurance. The contract is I buy car insurance from an insurance company. I give them a premium. I promise that I'm not going to do anything crazy, anything fraudulent. I'm not going to use my car for illegal use. And they promise to say, well, if you do all that, we're going to cover you and cover your losses. So let's look at this example. For an insurance company to be a valid contract, it must meet certain elements. The payment by the insured, so the payment by the insured of a premium in return for a promise by the insurer to pay certain losses if they occur is an example of, the answer is, consideration. So 4 distinguishing characteristics of insurance contracts. An aleatory contract is a legal contract in which the outcome depends on an uncertain event, and for insurance, it is an agreement whereby the parties involved do not have to perform a particular action until a specific triggering event occurs. Events are those that cannot be controlled by either party, such as natural disasters or death. So for an aleatory contract, values exchanged by the contracting parties are not necessarily equal. So that's due to the fact that the outcome of the contract is uncertain. So if a loss occurs, then I may pay a premium of $100 to get $20,000 coverage for my car. If a loss occurs, I pay $100 but I get $20,000 in return. So it's not an equal contract in that respect. And on the other hand, if no loss occurs, I give the company $100 and they just keep my $100 and I don't get anything. So the values exchanged for these types of contracts are not necessarily equal. So between one individual and the insurance company. So a conditional contract is where insurers must perform certain acts if recovery is to be made. So if the insured does not adhere to the conditions or to the conditions of the contract, payments is not made even though an insured peril actually causes a loss. So typical conditions where you're not going to get paid because there were conditions that you didn't fulfill or you didn't adhere to are payment of a premium. You don't pay a premium, you're not going to get, the insurance company is going to pay you out. Providing adequate proof of loss. Show me that you had a $20,000 ring stolen. Show me some sort of proof. Giving immediate notice to the insurer of the loss. Well, again, remember, these are general rules. If there's a loss in, somebody's worked in an asbestos mine 20 years ago, and they stopped working there 20 years ago, and then 20 years later they developed mesothelioma or asbestosis, some sort of asbestosis, then the person might not report the loss for 20 years, but they didn't know that they were going to get sick. So again, remember, these are hard and fast rules, but typically you have to report you have to give notice to the insurer of a loss fairly close, in a close proximity time-wise to when you find out about it. Okay. So that's points 1 and 2. Let's look at 3 and 4. So 3, contract of adhesion. A contract such as an insurance contract in which any ambiguities or uncertainties in the wording will be construed against the drafter, in the insurer in this case, because the company and its agent has the power to draft the contract while the potential policyholder only has the right of refusal. They can't counter the offer or create a new contract to which the insurer can agree. So this is probably true for most contracts, not just insurance contracts. So any ambiguities or uncertainties in the wording of the agreement will be construed against the drafter, the insurer. So if the insurer puts something in there and it's kind of not fair, then if there's legal action taken, it's normally the insurer is going to be in trouble, and the courts are going to take the side of the guy that just had to sign the contract, who had no choice in it other than to walk away. So the insurer has the advantage of writing the terms of the contract to suit its particular purposes. The insured has no opportunity to bargain over conditions, stipulations, or exclusions. Now, there's another doctrine of reasonable expectation which goes even further, saying that coverage should be interpreted to be what the insured can reasonably expect. So limitations and exclusions must be clear and conspicuous. This is kind of interesting, this doctrine of reasonable expectations. And we'll look at an example of that. And by the way, it is no excuse that the insured does not understand or has not read the policy. So that's not going to be, they can't claim, well, I didn't understand it and I didn't bother reading it. That's not really an excuse in the law. But let's look at an example of the doctrine of reasonable expectations. So an example of this doctrine is going to be illustrated by an actual case of an insured's policy that provided for burglary protection only when the building was open. I don't know whether they would take that policy out, but they did. But the literature used to sell the insurance referred to all risk or comprehensive crime protection and actually included a picture representing a burglary after a building was closed. The insured's claim resulted from a burglary loss after the building was closed, and it was denied by the insurer. But the courts actually ruled that the insured had a reasonable expectation for coverage to apply and required the insurer to pay for the loss. So this is an example of the doctrine of reasonable expectations. The person buying the insurance said, look, I looked at your literature, it had a building being broken into at night, and that's what I expected. And point 4, the distinguishing characteristics of insurance contracts. A unilateral contract is a contract in which only one party makes an express promise. So a promise typically in writing, it can be orally as well, but oral contracts are a lot harder to prove. Basically somebody offers you something, but they can't force you to take it on. So that would be a unilateral contract, is where somebody offers you something, but you don't have to take it. But if you do take them up on it, if you do take them up on what's being promised, the insurer actually now, the promise they made you, they say, oh, you know, we're offering you this insurance policy and we're going to give you $1 million if you scratch your car. If you take them up on that policy, then they're going to have to pay you $1 million if you get a scratch on your car. But you don't have to take it just because they've offered it to you. So let's look at an example here. Insurance contracts are often considered contracts of adhesion, which means that unclear language or ambiguities in the contract will be construed or interpreted in the favor of who? And the answer is going to be the insured. The person that gets insured, because the person that gets insured didn't write the contract, they just signed it. They didn't have too much choice. They could have refused it, but if they refused it, they wouldn't have had insurance. And most companies have very similar contracts. So if you're thinking, well, they could have gone to another company, well, most companies' contracts will be fairly similar. So let's look at the role of agents and brokers. An agent, and by the way, I'm telling you there's some ambiguity with these definitions, not for our purposes, but when you get out there in the real world, you have to look at the definitions of the company you work for or someone you do business with. You have to look at how they define agent and broker. But generally speaking, an agent is a person given the power to act for a principal, like the insurance company, and the insurance company is then legally bound by the acts of its agent. So you've got some agent sitting in a little office somewhere, and whatever they do on behalf of the insurance company, they're binding the insurance company to whatever they decide to do. Now, a general agent is a person authorized to conduct all of the principal's types of business, like in a particular place or location. So whether the company sells car insurance, life insurance, whatever, they can do everything. That's a general agent. A special agent, on the other hand, is authorized to perform only a specific act or function. Typically, these acts or functions are selling insurance, but they don't have to be. So an insurance agent should be assumed to be the legal agent of the insurer unless informed to the contrary. Okay, so if you got no information to the contrary, then you can, I guess, make that assumption. But you shouldn't live in ignorant bliss. You should ask. An insurance broker is the legal agent of the prospective insured. So the agent kind of works for the insurance company, and when you go to buy insurance, you actually go to a broker. I mean, that's the general usage of the words. So So the broker is the legal agent of the prospective insured. They are engaged to arrange insurance coverage on the best possible terms for their client. They're free to deal with they're free to deal with any insurer that will accept their business. And they cannot bind any insurer orally to a risk unless the broker has an agency agreement with the insurer. When dealing with a broker, one should not assume coverage the moment insurance is ordered, because they may not have the authority to give you coverage, and they may have to refer it back to the company to okay it. The distinction between an agent and a broker is not always clear. In some situations, a person may simultaneously hold both roles. So what is an agency agreement? It's just an agreement which sets forth the specific duties, rights, and obligations of both the insurer and the agent. And ratification is an interesting concept. If an agent who works for a company performs some act outside the scope of the actual agency agreement, which the insurer later assents to, or they let them get away with it, they let them do it for a long time, and they don't say anything about it, the agent has achieved what is known as ratification. So because they've done something which is beyond their the scope that they were given, but the insurance company seems to be happy about it, they're aware of it, they seem happy about it, then that would be ratification, and they can continue to do it. So these concepts actually repeat themselves, if you notice, as we go through the PowerPoints. So what's the authority of agents and brokers that let's look at the waiver part of it now. So what is a waiver? So a waiver is the intentional relinquishing of a known right. I waive it. I let it go. Okay? In contrast, an estoppel operates when there has been no intentional relinquishing of a known right. So estoppel actually operates to defeat a right that somebody has. So that's the difference between them. So estoppel, so for example, restraining a party from contradicting its own previous actions if those actions have been reasonably relied on by another party. So what does that mean? Let's look at an example. An insurer that has repeatedly accepted late premium payments from an insured may be stopped from later cancelling the policy on the basis of non-payment or late payment, because the insured has been reasonably led to believe that late payments are acceptable. It sounds a bit like ratification. So it operates when there has been no intentional relinquishing of a known right. So the insurer may say, the person collecting the premiums said, I didn't want to give up my rights, but you know what? Their rights may be taken away from them because they accepted the late payments for so long. And so estoppel operates to defeat a right that the party technically actually possessed. Now, remember, waiver is based on consent. Estoppel is imposed. Often these two doctrines are not clearly distinguished, even in court actions, and sometimes they're used interchangeably. Waiver and estoppel situations often arise when the insurance policy is first put into force. So let's suppose an agent writes a fire insurance policy with the full knowledge that some condition in the policy is breached at the time it is issued. So, for example, the insured may be engaged in a type of business that the insurer has instructed its agents not to cover and has excluded in the policy. But the agent, nonetheless, issues the policy anyway, and there is a loss before the insurer actually had an opportunity to cancel the contract. Most courts, but not necessarily all, most courts would say that the action by the agent constituted an acceptance of the breached condition, and the insurer would be stopped from denying payment of the claim. So, so there you go. That's the way that these things may end up working. So let's move on to social insurance now. Social insurance are insurance plans operated by public agencies, usually on a compulsory basis, and they're offered through some form of government normally the feds or the state government. So, for example, unemployment insurance, Medicaid, and they're usually on a compulsory basis. They're designed to benefit persons whose incomes are interrupted by an economic or social condition that society as a whole actually finds undesirable, and for which solution is generally beyond the control of the individual. If you notice that a lot of the time when the government speaks, it's saying we're going to change unemployment benefits, we're going to increase them because there's people that are unemployed through no fault of their own. So examples include crime, poverty, unemployment, mental disease, ill health, dependency of children or aged persons, drug addicts, drug addictions, industrial accidents, divorce, economic privation. Privation just means absence or lack of basic necessities of a certain class. So insurance is not the typical insurance that we talk about, but from an insurance company is perhaps not the most appropriate method of solution for many of these problems, because the peril is not doesn't fulfill those 6 items that we were talking about, those 6 requirements, because it is not accidental, fortuitous, or predictable. But there are companies that do sell private insurance for some of these things. Okay, so following the 9/11 attacks, firms actually could not secure terrorism insurance in the private insurance markets. After the insurers and reinsurance took a massive hit on 9/11, they didn't want to touch it anymore. So basically what happened is that the government actually got involved, and they actually set up risk and terror insurance that you can actually buy through the government. And sometimes the government backs in the UK, when there was terrorist attacks there back in the 90s, the insurance companies didn't want to have they don't want to sell terrorist insurance anymore. So what the government did, it didn't sell insurance itself. It backed the insurance company. It says, you sell the insurance, you sell this insurance to these people that want it, and what we'll do is we'll guarantee you. So we'll be behind you, and we'll give you money if you run out. We won't let you go bankrupt. So there's different ways that governments can be involved. So what are the principles of social insurance? And it's interesting that we're using the word insurance, but in a slightly different way. First one is compulsion, and it means it's necessary that everyone involved cooperate. It's actually necessary that everybody actually contributes to it. It's you don't really have a choice in most countries and most states. You have to actually make a contribution and cooperate by giving them money. There's a set level of benefits, and there's little of any choice is usually given as to what level of benefits are going to be provided. So when you get regular insurance, you can actually choose the level of benefit, but with social insurance, it's like there's set levels. So, for example, the maximum amount you can get as unemployment insurance per week is like $450, and that's been the case for many years. And you will only get the $450 depending on how much you've actually put into the system, but its max is out at $450. Of course, that the government has come in and topped that up when there's been bad things happen. So that's a possibility, but the actual amount is maxed out at $450, and you don't set the levels yourself. Now, all persons covered under the plan are subject to the same benefit schedules. So there's there again. So no one can get more than $450 a week on unemployment insurance. So there's something called floor protection. So floor protection is an underlying principle of social insurance, specifying that the goal of social insurance is to provide only limited protection, not one's entire need. And for subsidy, and this is going to come up again in a later point, there's several points for principles of social insurance, but subsidy, losses of the unfortunate few are shared with the fortunate many who escape loss. So we all pay into unemployment insurance, and if we're lucky enough not to be unemployed, we don't actually pull any money from that fund, but people that are unfortunately unemployed, they will pull money from that fund. So the losses of the unfortunate few are shared with the fortunate, many who escape loss. So if it's anticipated that an insured group may not pay its own way, it will be subsidized either via other insured groups or by taxpayers. So yet again, the example I just gave you works well for this one. With pension schemes, when you buy a pension, or when you buy a pension privately, is going to be a different situation to this. So the government actually provides some sort of pension to people, and they actually ask you to contribute. Rule 1 is a compulsion to contribute, and there's going to be a set level of benefits. But when you contribute to a pension, the money you're putting in now, there's no fund created for you and say when you get to 67, say the money's going to accumulate and we're going to pay you out of that. And they're not going to do that. What they do, the money you pay now is actually to pay for people that are currently, say, 67 or older, and it's paying their pensions. There's no funds actually, and there's this concept of cross-subsidizing. People that are working now are actually paying money for pensions that are going to be for people that are currently retired. So by the time you guys get to retire in 40 years' time or 50 years' time, when you finally end up retiring, all the money you've put in over the next 50 years into the scheme, you're not actually going to receive any of that money. But the money you will receive is from people that haven't even been born yet, that are going to be working when you retire, and they're going to be taking their money to pay you. So that's it, it's going to be subsidized. So let's move on. 5, unpredictability of loss. Cost of benefits under social insurance cannot usually be predicted with great accuracy. So therefore, the cost of some types of social insurance is unstable. For example, in a general depression, unemployment may rise to unusual heights, and I think we've all experiencing that, causing tremendous outlays in benefits that may threaten the solvency of the unemployment compensation fund. But I guess governments can always print money. Point 6, conditional benefits are means tested. So what I mean by this is if one earns more than a specified amount, various social insurance benefits may be lost. So they say, look, what are your means? How much money do you have? And there's certain things that you say, well, you don't qualify for this now because you actually were earning too much money. Or you've got too much money in the bank. You may be unemployed, but you don't. There's certain benefits you qualify for, and others you don't because you have too much in the bank. So they can be means tested. Unemployment, incidentally, in the USA is not means tested. So you can be a billionaire that loses your job, and you'll still be entitled to get $450 a week. And if there's any government top up, you'll be entitled to that as well. 7, contributions are required. So on point 1, I said cooperation, and there's cooperation. They basically want you to pay. But contributions, it's a similar point here, but I guess they want cooperation in more than just point 1 that we had for these principles of social insurance. Let me just go back to it. Point 1 was compulsion. So basically, everyone's forced to be involved in it. We use the word force. Everyone's forced to be involved in it. And point 7 is everyone is forced to pay into it. So a public program should require a contribution, directly or indirectly, from the persons covered, the employer, or both. This does not mean that the beneficiary in social insurance must pay all of the costs, but the beneficiary must make some contribution. Otherwise, the program is not really an insurance program. We kind of know it's not really an insurance program anyway, but rather a form of public charity. So, but people do pay into it. It's not a charity. So, for example, welfare payments to dependent children are not a form of social insurance, as the term is normally understood, although such payments are undoubtedly made to solve a social problem. Social insurance does not include public assistance programs like food stamps, wherein the needy person receives an outright gift. So with these public assistance programs, the needy person receives an outright gift and must generally prove inability to pay for the costs involved. So public assistance is provided only to those people who are not responsible for their own poverty, such as children, the aged, disabled. So we've mentioned this stuff before. Fit working aged adults without children tend to be out of luck and deemed undeserving on most public assistance. So there is a difference between public assistance and welfare. an attachment to the labor force. Most social insurance plans cover only groups that are or have been attached to the labor force. And nearly all such plans are directed at those perils that interrupt income. So basically, I guess there's like big political debates, and this is not a political subject, but should illegal immigrants be getting unemployment? And because they have been attached to the labor force, a lot of them have been attached to the labor force. So, people are up in arms, and there's people on both sides arguing these things, and everybody believes that they're right, and everyone's right in their own mind, I guess. So let's move on to the last one. 9, minimal advance funding. Social insurance usually does not provide large accumulations for advance funding. So the thing I was telling you about earlier about the pensions, there's no advance funding for your pension. You have a pension, and you're actually cross-subsidizing. You're paying money now, the money that you guys are going to be paying during your working career, towards your social pension, not your private pension. Your private pension is different, but towards your social pension, your social security stuff. The money you're going to be paying will not go into a fund for you. That money will be going out directly and paying people that are currently retired. And then when you get to retirement, then the money that you're going to be receiving is from people, as I said, that haven't been born yet, and they're actually working and paying into the system to actually pay you. So there's no real funding in a lot of these social insurance schemes. So when it comes to insurance, what are the social and economic values of insurance? So we could look at a few of these, the values that insurance actually brings us. So one of them is reduced reserve requirements. One of the chief economic burdens of risk, when you face risk, is the necessity of accumulating funds, having money put to the side to meet possible losses. So you have to put money to the side for a rainy day. One of the great advantages of insurance is that it greatly reduces the total of such reserves necessary for a given economy, for an individual, for that matter as well. Because the insurer can predict the losses in advance much better than an individual, and also an insurer has a whole host of risks, so they could spread their risk. It needs to keep readily available only enough funds to meet those losses and to cover expenses. And since it can predict them so well, then it can actually really be very efficient in how much funds it holds in reserve to be able to pay for a rainy day. If each insured had to set aside, if each of us had to set aside funds, that would that there would be a need for a far greater amount. So again, if you think about it, I've got a $20,000 car, and I'm worried it might get stolen and never recovered. And so if I'm actually going to hold a fund for the rainy day if my car gets stolen, I might think, well, I need to have $20,000 in that fund. But if I go and buy insurance for $400 a year, or $700 or $800 a year, then I'm actually now covered. So I don't have to have $20,000 in a reserve fund. So reduce reserve requirements. And also, the insurance companies are more efficient at doing that job than I am, because they have not only do they have experts, but they've got the law of large numbers. They've got massive amount of people insured with them. Another benefit is capital freed for investment, which I guess touched on it a little bit on the previous point. Reduce reserve requirements. When people hold less money in reserve, then there's more money out there for investment. Cash reserves that insurance accumulate are made available for investment. This is another thing. So especially life insurance companies, and pensions companies, they hold so much money, and they are some of the biggest investors in real estate, in stock markets, in everything. So if I was holding the money, $20,000 to cover my car in a reserve fund, now that I release the money, I paid $750 for insurance, and I don't have to keep that fund at all. But the insurance company will keep some sort of fund for my rainy day, not $20,000, but a different amount. But those funds, it can manage them so well that it doesn't have to keep that much, and a lot of it is available for investment, and that that's going to hit the markets, and there's a lot of benefits from that. So, the capital freed encourages new investment. So if, for example, if an individual knows that his or her family will be protected by life insurance in the event of a premature death of the main breadwinner, the insured may be more willing to invest savings in a long-desired project such as a business venture without feeling that the family is being robbed of its basic income security. So these are the benefits for insurance. So some of these benefits actually begin to overlap. So let's look at the next two. Reduced cost of capital. Because the supply of investable funds is greater, the insurance companies have so much money which they actually put out there into the markets. Basically, the cost of capital is less. The cost to get a loan is less. So capital is available at a lower cost than would otherwise be the case. It can bring about, not necessarily, but it can bring about a higher standard of living, because increased investment will raise production. If you are investing in more companies, giving them more loans, they're going to produce more stuff, and that can cause lower prices. There's more stuff. There's bigger supply. It can lower prices as well. So there's lots of possible benefits. I'm not saying they all come into play. There's a reduced credit risk as well. Insurance has been called the basis of the nation's credit system. So today it would be nearly impossible to borrow money for many businesses, for many business purposes, without insurance protection that meets the requirements of lenders. So if you take, for example, I want to get a mortgage on a property, a lot of the times lenders aren't going to want to give me the money. But once they find out, look, I'm going to take out insurance, and here's the insurance. So if I don't repay you, the insurance company is going to pay you. They're more likely to say, well, the credit risk to me is reduced because even if this guy screws up, he's backed by the insurance company. So let's look at loss control activities. So these are some of the loss control activities that are also beneficial to everyone. Although the main function of insurance is not to reduce loss, but to spread losses amongst members of the insured group. That idea about cross subsidies and about having a lot of people insured, so one person's premium pays for and somebody else's loss. For the unfortunate ones actually can pull money from the people that are more fortunate. Insurance are nevertheless vitally interested in keeping losses at a minimum. Otherwise, losses and premiums would have a tendency to rise. So they want to be competitive. They want to keep their costs and losses down, so they can offer you a cheaper product, a less expensive product. So illustrations of loss prevention and control in the field of property and liability insurance are, this is what insurance companies do. One of them is investigation of fraudulent insurance claims. So that puts people off from, you've got the threat of being investigated by insurance people. So it makes you less likely to do something fraudulent. I'm not saying it doesn't happen. Research into the causes of susceptibility to loss on highways. They can figure out why is this particular junction here? Why is there so many accidents here? Maybe they find something out and they can actually report back on it and do something about it. Recovery of stolen vehicles and other auto theft prevention work. So if they stop your car being stolen, they're able to recover it after it's been stolen. That reduces the cost. And is this beneficial to you? Who wants to go through having their car stolen? Development of fire and safety standards and public educational programs, which they do. They educate us on what we can do to actually avoid our houses burning down. Provision of leadership in the field of general safety. So in America, we have the Occupational Safety and Health Administration, and that's an agency here in America, an agency of the Department of Labor, known as OSHA. And basically, they put on they actually go and check buildings, they check people for safety. They're actually kind of a powerful agency. Provisions of Fire Protection and Engineering Council for oil producers. So if we just look at oil producers, they're much more likely to have fires, and if they do have fires, they can be devastating. So the insurance companies actually look into ways of mitigating losses for them, investigation and testing of building materials to see that fire prevention standards are being met. So they're going to use fire retardant stuff to build buildings with. So if there is a fire, the loss is going to be less than they would have been otherwise. Well, hopefully. So social and economic values of insurance, but let's look at the business and social stability. So finally, the existence and availability of insurance can lead to increased business being done and social stability. If adequately protected, a business need not face the grim prospect of liquidation following a loss. So if my business burns down, if I don't have any insurance, maybe I have to liquidate because I'm done. I've got no money to back it, and I've got nothing apart from a pile of ash. But if I have insurance, they can actually restore me to where I was before. The second one, a family need not break up following the death of or permanent disability of one or more income producers. Many times in the past, when people didn't have insurance, if the breadwinner, as it were, died, then all the kids had to go out and get works, and they'd be working in different locations, and the family would kind of break up. So now with life insurance, that doesn't have to happen. The next point, a business venture can be continued without interruption, even though a key person or sole proprietor dies. There's different types of insurance for this. It still may be a bit difficult, but if you can collect money from insurance, I guess you've got more money to hold you over until you can actually replace that person. You may lose a lot of business if that person dies, and if you get money, that can actually give you time to find somebody else to replace them with. I'm just giving examples here. A family need not lose its life savings following a bank failure, because there's got things like the FDIC, which protects your money if a bank fails up to a certain amount. Old age dependency can be avoided. So old people often have to depend on family members and sometimes even handouts. It's kind of really sad to see that, but you can actually prepare now, and you can actually buy policies. You can put things in place so you can be cared for as you get older and if you become more frail. Loss of a firm's assets by theft can be reimbursed. So again, you won't have to suffer that loss. So it's great for business. And whole cities ruined by a hurricane can be rebuilt from the proceeds of insurance. Imagine if there was no insurance and we have these massive disasters. The government only puts so much into them, if anything at all. But the insurance companies actually step up and actually put money into them, and they can restore social stability and businesses. So let's look at an example. One of the chief economic burdens of risk is the necessity of accumulating funds to meet possible losses. So, it's putting money to the side for a rainy day. If an individual owned a $20,000 car and the car could be insured against property damage for $400 a year, how much of reserve fund would the owner likely feel he would need to accumulate if the insurance was not available? Well, if the insurance is not available, so they could suffer a $20,000 loss. They've got no safety net. It's probably going to be a lot more than $400 that the insurance is going to cost them. That's what they would need. So insurance makes sense. So operating the insurance business. No institution can operate without costs. The costs for an insurance institution include operating the insurance business, losses that are caused intentionally and losses that exaggerate, which we're going to talk about in a minute. These last two are moral hazards, but basically the insurance companies, there are costs associated with them. So this is like a little bit the downside, if you like. So the first downside, and I don't necessarily think it's a downside, but let's put in some possible downsides, is operating the insurance business actually takes a toll, because most businesses, as you can see here, they take up a lot of labor. And you can see that property insurance, about 27% of their earned premiums actually spent on labor, and life insurance about 17%. By expenses predominantly on labor. And that's saying, well, what the point of this is that you're pulling labor resource into insurance when it could be used elsewhere. Well, at a time when there's unemployment, I think insurance companies are doing a great job. It's a great service to the country. So this is, I think it's a benefit as well that they're actually employing a lot of people. They actually employ a lot of smart people as well. So that's why maybe it's seen as a bit of a drain in certain respects, because you're going to get a lot of guys, women qualifying as actuaries and risk managers and so on to help the insurance companies. But there's a lot of benefit they offer. So even this is put down as a cost. I think it's a financial, we can put it down as a financial cost, but I don't think it's a cost to society. And I don't really see it that way, but let's look at the next couple here. So social and economic costs are losses that are intentionally caused and losses that are exaggerated. I briefly mentioned them on the previous page. So losses that are intentionally caused. A second social cost of insurance, and this, I do believe this is a cost, but it's not insurance's fault. It's kind of, the insurance is the victim here, if you like. But a second social cost of insurance is attributed to the fact that if it were not for insurance, certain losses would not occur. So losses that were caused intentionally by people in order to collect on their policies. So, if there was, if you have a restaurant and it's not doing well and there's no insurance, you're not going to burn it down. You're going to try and sell it or whatever you're going to do. But, it's been known that some people, the insurance, they're not doing well, they have insurance, the restaurant's not doing well, they have insurance, and mysteriously that restaurant burns down, they collect on the insurance. So those sort of losses would not have occurred if it wasn't, probably wouldn't have occurred if it wasn't for insurance. So insurers are well aware of this danger. Then we're not stupid people, we're very smart people, however, and there are numerous steps taken to minimize this type of thing happening. And what's the third cost? So the third cost we're going to look at, So the third one we're going to look at, which is seen as a cost, is losses that are exaggerated. So this is kind of an interesting one. So related to the cost of intentional losses is the tendency of some insurers to exaggerate the extent of damage that results from purely unintentional losses. So what that means is that there was a real loss. Your house really was burglarized. But you exaggerate it because, you say you're going to add into your, when the insurance company comes around and says, what did you lose? You're going to say, yeah, they stole the television and they stole this, that. And you're going to may add a couple of things in there, like there was a computer that wasn't stolen that you may actually throw in there. So that's an example of losses that are exaggerated. And if there was an insurance, people wouldn't be doing that. So this is another cost that, a negative, if you like, about something connected to insurance. But my perspective is like, some people are going to use knives badly. So is that a reason to ban knives and not have knives? No. I mean, if people decide to be dishonest, then you can't blame everyone else for the dishonesty of some. So insurance is a great thing. I've been working in it all my life, and it offers a lot of benefits to society, as we've just looked at. So I've got another example here. Supposing there's a company that has an old photocopy machine that does not work well. Supposing there's a small fire in this company's building and it causes smoke damage throughout the building. That company may be tempted to claim that its fire insurance should pay for a new photocopy machine. Now, the old machine likely has been affected by smoke, but in reality, the machine may have not worked well before the fire and probably would have been replaced soon anyway. So the existence of insurance tempts that company to exaggerate its loss in this situation. Now, similarly, health expenses for families that have health insurance may be higher than the expenses of uninsured families. Once an accident or sickness has occurred, an individual may decide to undergo more expensive medical treatment, or even the physician, the doctor, may prescribe, if it is known, it may prescribe more work, more tests, if it is known that the insurer will bear most or all of the cost. But again, so if people are doing fraudulently, it's kind of unfair to blame the insurance company. Now, at the end of these, this was actually one chapter split in two because it was long. So this is the summary for both chapters 7 and 8. So we have the summary here and then the key terms and concepts.